Happy Wednesday, Asher here with your latest market update. Let's talk about what's moving the markets this week and how it could affect your buyers, your sellers, and clients in the weeks ahead. This morning, we got the March retail sales report, and while it came in slightly hotter than expected at 1.4%, there's a twist. A lot of the spending appears to have been pulled forward due to the looming tariffs. Consumers were racing to buy imported goods while prices were still low. Clear evidence of that shows up in the 5.3% spike in auto and parts sales alone. That's a massive monthly number. But when you dig deeper, the core retail sales numbers, one that feeds into the GDP, came in below expectations. And that tells us that future consumer demand could be weakening, which might show up in the next few reports. We're keeping an eye on how the Atlanta Fed updates their GDP estimates, which were already sitting at a negative 2.4%. Industrial production was also released today, down 0.3%, worse than expected. This is a metric that the National Bureau of Economic Research watches closely when considering recession calls. So all of this could be pushing us closer to a formal recession designation. On the inflation front, capacity utilization remained below 80%. That's actually a good thing in this environment. Lower capacity means producers can't charge as much, which can help cool inflation down. And speaking of inflation, Realtor.com's rental report showed that asking rents dropped 1.2% year over year. That's the 20th straight month of rent declines, which again is good news for future CPI data. Mortgage demand cooled slightly last week as rates moved up again. Purchases and refinances were both down, but here's the silver lining. Rates are still 32 basis points lower than they were a year ago, which helps us keep the longer-term outlook hopeful. Now, looking ahead, today at 1 p.m. Eastern, which might have already happened by the time you watch this video, we have a 20-year bond auction, and I'm going to be watching foreign participation closely. Last week's 10-year auction saw record high international demand, and today's results could either confirm or challenge that trend. Then at 1:30 p.m. Eastern, Fed Chair Jerome Powell speaks, and let's be honest, a lot has happened since we last heard from him. Expect markets to react to anything he says on tariffs, inflation, interest rates, or labor market trends. Keep an eye out for that. Katie Stockton, who is a respected market technician, sees near-term weakness in the stock market, and she's targeting a drop in the S&P 500 down to 4,500. It's currently closer to 5,300. On the bond side, she believes yields could test 3.8% or even 3.6% on the 10-year before potentially heading higher over the long term, maybe even above 5%. If we get to those short-term downside targets, it could be a window of opportunity, so be ready for that. Right now, though, the 10-year is sitting at 4.33%, right at a critical Fibonacci level. If we break below it, we could see some additional downward movement towards 4.27 and even 4.23. That would be great news for mortgage rates. At this time that I'm recording this, mortgage-backed securities are currently up 5 basis points and have broken above the 100-day moving average, which is positive momentum. We have good momentum that is building. There's still room to run, though, before we hit any resistance, and if this trend continues, we could see rates improve again this week. All this reinforces the importance of staying prepared and being ready to jump at a moment's notice. Talk to your buyers and get them ready to move when the opportunity presents itself. These rate dips don't last long, as you've seen here in the recent memory, and the window could close quickly. Quick note. Foreclosure activity ticked up in Q1 of 2025 for the first time in 3 quarters. ATTOM reported that 94,000 properties with foreclosure filings in the first quarter. This is an 11% jump from fourth quarter of last year. It's still down slightly year over year, but it is something that is worth watching. So to sum it up, the data is mixed, the volatility continues, and there's a lot of headline risk out there. But with the right preparation, there's also plenty of opportunity. Thanks for tuning in. If you want to talk strategy or get help walking your clients through all of this, I'm just a call or a message away. I'll see you next week.